Hey, welcome to the New Home Insights podcast by John Burns Real Estate Consulting. I'm Dean Worley, your host. Each episode, we're going to bring you some of the best minds in the housing business talking about some fascinating topics or trend or innovation or issue, just like the one you're about to listen to. Enjoy. Welcome to the New Home Insights podcast. That's the John Burns Real Estate Consulting podcast about the U.S. housing market. I'm your host, Dean Worley. I know we've done a lot about the rental world lately. We had a whole series on the build for rent space just in our previous iterations here. Today, we're going to further explore the rental world, go back to that old standby, the apartment market. And to help us do that, we're going to talk to Jay Parsons. He's a vice president at RealPage. RealPage is more than just about apartments, though. They do software and management for kind of the entire rental world, including the commercial a little bit. I'll let Jay talk about that better than I can, though, in just a second. But our topics are going to explore things like the demographics and fundamentals of the apartment market here, what shifts might be coming, what trends we're seeing, lots of stuff. So we'll get into a lot of meat here in just a second. First, let's start with, good morning, Jay. How are you doing?
I'm doing well. Thanks for having me.
Thanks for being here. So tell us a little bit about you, just kind of your background, and also about RealPage.
Sure. So I joined RealPage as a market research analyst back in 2009. So right during the worst of the last housing bottom, I should say, of the last housing cycle. And now have the opportunity to lead our economics industry principal team. So RealPage is a global provider of software to real estate owners and managers, and a big part of our business is rental housing, apartments, and single family rentals. And so a lot of what I get to do is get data out of our platform in the same way that ADP processes so many payrolls. They have a lot of great data on the economy through payroll information. We have the same thing through our software and rental housing.
I'm just impressed that you got a new job in 2009. You were one of the few in the country at that point. So yeah. That's a good intro. So let's talk about that initially. So let's start with talking about big picture, 30,000 foot. Let's talk about the apartment market and maybe kind of what's hot, what's not. First though, let's sort of set up the basis here. Where do you derive the data from that you're going to talk about here?
Yeah, so we get data from a few different sources, just to real high levels. RealPage, over the past number of years, acquired a couple of big apartment data collectors that did traditional surveys. Some of your listeners may know the names of Axiometrics and MPF Research, and those have been kind of folded into the RealPage umbrella over the years. And then, but the better, a deeper source of data comes from the software itself. So RealPage offers property management and business intelligence, and all the big revenue management tools are coming through RealPage. And so we're able to glean data from actual rent rolls, and that gives us a much better visibility into, not just the new lease asking rent, which quite frankly is probably the most overrated metric in rental housing, and certainly the most misleading. But we get insight into what are people actually paying to sign a lease, and retention rates, renewal rates, what's the actual rent roll movement, revenue, all that type of stuff. So it's a real gold mine of insight into the apartment market.
In a sense, then, it's sort of just a massive sample of the whole national apartment market.
Yes, yeah, we RealPage services more than 10 million units across the country, and there's a smaller subset of that where we look at market rates, stabilized apartments, where we can kind of pull that daily information out of, and so it's a very big data set, and it definitely makes my job a lot more fun.
We like to be flexible here at the podcast at New Home Insights. So I'm going to ask you, first question is going to be different, is why do you find the asking rent to be such a misleading indicator?
Oh yeah, this is one of my pet peeve topics. Asking rents are a commodity these days. I mean, you could get, you look at, just depending on what headline and what source you pull up, you can get very different stories on what's happening in the apartment market or rental housing simply based on who provided it. There's a number now of internet listing sites that have asking rents coming out of it. And they don't always agree with each other. And the reason is that they're different methodologies. They cover different properties. But even more importantly, in a tight market like today, people forget that asking rents only cover the tiny sliver of units that are, number one, available at a given time, and number two, that the property managers are choosing to advertise. And so, I mean, vacancy right now is less than 3%. And so, why in the world are we gauging the health of the industry based on data covering 3% of the market? It doesn't make any sense. Then beyond that, in the affordability narratives, these asking rent data is oftentimes extremely unhelpful, because the asking rent is exactly that. It's not what people pay. And so one of the reasons that rent income data on apartments is 100% wrong almost 100% of the time, unless it's coming from a data source like ours or an actual owner or operator of real estate, is they're matching asking rents from a private data source, and then which is generally covering market rate, and they're mashing that with census data on incomes for all renters, which is going to create a really skewed picture and showing rent income ratios much higher than they really are. And so, asking rent is just that. I mean, asking rents don't often get signed at those rates. It's very seasonal in terms of leasing velocity. And so I could go on and on and on. It's extremely misleading, and it doesn't actually tell you much other than marketing information.
So in a sense then, to play back on the whole sampling, we talked about how your data is based on a huge sample. Asking rents data is often based on kind of a skewed sample, isn't it? Because again, it depends on what units that apartment complex is advertising.
Well, and I'll give you one other thing too, is that, nowadays asking rents, there's not really a number, meaning that your rent is going to vary many times based on, especially for apartments, on your move-in date, your move-out date, and certain floor plans that you pick. I mean, there's different floor plan premiums. You have a unit by the dumpster or by the pool. Well, it's going to be priced differently. And so it's a matrix of pricing options that a prospective renter oftentimes gets. And then what these internet listing sites do is they're just picking a number without any visibility into what the renter is actually picking.
So sort of methodologically, that means, it should mean anyway, that the bigger your sample is, the more of that noise is going to be solved, is going to be standardized. Is that fair to say? So if you do get a big sample, you do kind of lose some of those peculiarities of that data noise that with the smallest sample.
Yeah, but I also think it's just about better metrics. I mean, I'll give you this as an example. It's like for an owner or operator of apartments, they're never looking at asking rents as a KPI for their own portfolio. And so I oftentimes tell some of my friends who look at that data point, it's like, hey, if you don't look at that for yourself, then why are you looking at it for your peers as a benchmark? It's meaningless. And so better metrics are things like lease over lease, rent growth, or trade out or replacement rents, different terms for it. But it's what people actually pay and sign, not what's advertised on a website somewhere. So you could have the most sample in the world, but if it's just junk data, it's still not going to tell you much about what's happening.
Okay. All right. Well, that was good. That was fun. So now, having said that, let's talk about your sample and your data. Yeah. You are. That's good. We need data nerds. So let's talk about the general state of the market. Think those. Well, I'm not going to constrain you to those traditional things like asking rent and occupancies. What's your feel right now? The apartment market. How strong is the apartment market right now? What are the best metrics to sort of measure that?
Yeah, no, I think apartments are just like all types of housing right now. There is a severe shortage of housing of all types and at all price points and in all locations, and apartments are no exception. We have vacancy at the lowest levels on record. Net absorption of last year was not only a record high, but it was something like 60% higher than any year in history. Rent growth is at the highest levels on record, as everybody at this point really knows. Retention rates, people are renewing their leases at the highest rates on record. And then also importantly, renter incomes are shooting up significantly as well. We track incomes at the time of lease signing, and we're seeing consistently double-digit growth over the last year among people signing these leases. And bear in mind, nearly half of units get turned on an annual basis. So you're dealing with a pretty significant data set there. So overall, it's a very strong market right now. The way I like to separate that, though, is I think a lot of times, you have to remember that apartments, it's a very bifurcated market. You have the market rate sector, which is on fire. There's really no affordability challenges. But on the lower side of the market, we hear concerns about affordability. It's really the lack of affordable housing. And I don't want to get too much in the weeds on this, but there is a severe issue there. But it's generally among renters who weren't living in market rate apartments even prior to the pandemic.
Okay. Are earning incomes that are just can never play in the market rate field, at least the newer or newish market rate apartment world.
Yeah, there's an enormous depth of demand for these higher rent apartments from higher income households. In fact, Harvard's Joint Center for Housing Studies they put out their big rental housing report earlier this year, and one of the findings from that report showed that the fastest growing segment of renters over the last decade have been upper income renters making more than $75,000 a year, and so it's been relatively flat in other income groups, but we're just seeing enormous household formation among renters in these upper income brackets. That's what's helping feed demand for these new lease ups at high price points.
Let's back to that in a second, Jay. We'll come back to that in just a minute. But first,
Yeah.
let's finish up with the market, what's hot, what's not, or in this case, I guess it's relative, isn't it? So I was going to
Yeah.
ask you, what are the hottest markets? They're all hot markets. So not what are the hot markets. What are maybe a couple of the hottest markets right now?
Yeah, that's a good way to put it. Because sometimes I get on these panels at conferences and they want to talk about what's hot and what's not, and then I'm always like, there's nothing to say about. There's no cold markets. There's just some markets that are hotter than others. In terms of what's the hottest, it's John and I've talked about this in the past. Is that that people oftentimes think of rentals and for sale homes as competitive, maybe seeing different trends in different places, but they're not. I mean, they really move in the same direction. So the areas we see the hottest apartment markets are generally the places where we see the hottest for sale markets. That's generally the desert region. People pay places like Phoenix. It's Florida, all over the state. Florida's on fire. But then generally speaking, a lot of the Sun Belt, Texas, the Carolinas, Nashville, parts of Southern California that are not Los Angeles, but outside of that area, some of the mountain regions, Salt Lake City and Denver. And so, those are the places that are benefiting from a lot of in-migration right now. And as a result, the housing market, both for sale and also the for rent apartment side, is just on fire.
Yeah. Is there any kind of a denominator effect in that at all? That is to say, a lot of those Sun Belt markets are those markets that come from relatively lower rental rates. So when we look at year over year or kind of metrics, that kind of just helps nudge them up in terms of percent growth. Is that fair?
Yeah, yeah, absolutely. I mean, certainly, these are less mature markets, and so as a result, I mean, part of the reason they're growing is their lower cost of living, and that includes the cost of housing. And so the lower denominator is a big piece of it. And now, we did some research recently showing that we get a lot of questions like, "Hey, if rents are going up by double digits in the Sun Belt, it's not affordable anymore." It's like, well, affordability doesn't change on a dime that fast, right? And so, while the gap has narrowed a little bit, on average, a Sunbelt apartment is still about 45% cheaper than living in a coastal city.
Yeah, that's a great point. It's just the same in the for sale world where, yes, Boise or Salt Lake City for sale housing prices have skyrocketed, but to that Californian, it's like, oh my God, let me buy three. That's
Yeah.
what a deal.
Yeah, we hear that all the time. It's pretty funny. And the other thing too is now that rents are really growing in these coastal cities again. It took obviously took a hit in 2020, but started to come back second half of last year into this year. It's eroding. So it's that shift of a shrinking premium is going away again. And so we're starting to see again that it's a much better, much lower rates in the Sun Belt than the coastal cities.
Okay, so that's the what, I guess, in a sense. Let's
Yep.
talk about the why. What are those most critical demand drivers that are fueling this very strong apartment market?
Yeah, good question. I mean, I think it all starts with household formation. I've had this conversation with some of your colleagues, and I think Rick and John have had some really good data showing that household formation is a lot faster than some of the government sources, the official sources are really given credit for. In fact, I saw y'all put out some data sets on electricity hookups, which is a really interesting way of looking at household formations and so that's the number one driver. I mean, everyone's always like, "Hey, where are these people coming from? There's, economy's bad and all this yada yada yada." And it's like, well, it's not as bad as we probably think. We're seeing a lot of new household formation, and particularly among young adults. And so, people moving out of mom and dad's place, roommates that are decoupling. I mean, think back to 2020. We had this, we had a whole generation of college graduates who had nowhere to go. And so during the heart of the lockdowns and the pandemic, and so they just kind of surfaced in 2021. And then I also think we saw some fast forwarded household formations for rentals in last year that, people like moving out of New York or San Francisco who are going to do that anyway. We're not big believers in like everybody left the city. I mean, we're not death of the city
Yeah.
people at all.
Okay.
But there was a segment of the population that was going to leave anyway and move into the Sun Belt for that next phase of life. And maybe that was going to be in 23, 24. And they went ahead and made that decision a little bit earlier. And so I think it's come from a variety of sources. But again, I think it generally stems to the fact that the economy was doing much better than people thought. Especially, came back faster than expected. Wages have gone up significantly, and people had, more buying power and wanted more space. And so, at the end of the day, and unemployment's at, lowest
Yeah.
levels in decades. So all of this stuff is, playing together just to go back to household formation and demographics.
How much do you look at demographics or how fine tuned? I think depending on how you measure it or how you define it, Gen Z is actually as big or
Yeah.
bigger than the millennial cohort. Yeah, I mean, so and Gen Z is now coming into their rental years. I mean, does that indicate to you that the good times for apartments are going to just kind of keep on rolling?
Yeah, that's a good question. I mean, a lot of people make, on the other side of it, people make a big deal about the fact that the peak growth rates among people in their 20s starting to slow down a little bit. But the point I would make back is what you just noted, which is that there's still this big wave of Gen Zers, and to whether where you draw the line of millennials to Gen Z
Yeah.
is somewhat arbitrary. But either way, the important thing to note here is that growth trend it moderates, but it doesn't go away. And that's important because if you go back to what happened after the baby boomer generation, Gen X came to adulthood in, let's say, late 80s, 1990s. And in that time frame, we saw, half the number of young adults as we saw, Gen X was half the size of the boomers. And so
Yeah.
that's what, created some challenges on the demand side. Now, going forward, that's really not the case for the reason you just mentioned. I mean, Gen Z is very sizable. And so that's a good tailwind. At the same time, for a variety of reasons, people are choosing to stay put in apartments longer than in previous generations. And so you kind of have positive drivers on both sides here, the front end and the back end.
Yeah, yeah. The baby bust, in a sense, was Generation X, and that doesn't appear to be happening now, or it's for sure not happening. We can see the numbers. How do you characterize renters? And let's go back to what you said about income a minute ago. So you're saying that you've seen in truth rental household incomes are actually pushing up, and they're pretty affluent now. Is that fair?
Yeah, no, we're just looking at market rate apartment renters, and
Okay.
so it's definitely a segment of the market. But I think there's a lot of kind of conventional wisdoms that just aren't true about renters. I mean, a lot of renters, it's not just about it's cheaper to rent or buy or can't afford a down payment or to buy a home. Like especially in the apartment market, like these are people who are in an apartment phase of life. They're more likely single. They're less likely to have kids. They don't really know where they want to settle down yet. They need that flexibility or want that flexibility. And what we're noticing is that, in this demographic, again, on the market rate side, they're seeing significant wage growth. You think about who's doing well in this economy. We saw early retirements among older adults and through the pandemic. And then we've seen this hiring challenge. And so where it's really created opportunities is what I would call kind of your senior contributor and lower level manager level, where you need people who just, do stuff. And oftentimes those are people who are in their, mid to late 20s and into their 30s. These are people who are not your most senior, but they've got some experience. And a lot of them are living in apartments. And so they're moving around, they're bringing in bigger incomes. And that's really driving up the whole market. And so we're seeing a lot of rent growth, but the income is keeping pace with it. And what I oftentimes have to remind people is, hey, like you can't push rents if people won't pay those numbers. And rents are getting collected. I mean, the rent collections are near normal levels. Vacancy is at near record low, or is at record lows, I should say. Demand is through the roof. None of this happens if we were hitting an affordability ceiling.
Do you think there's any element of some households being pushed, quote unquote, into the rental world because of very high for sale housing prices and also very, very low for sale supply?
Yeah, no, I mean, I'm not ignorant to that, of course, but I think it's a lot of times not being pushed into rental so much as they're staying in place longer. So when you look at net new demand, it's really not so much impacted by that. That may be impacting the retention side more. But I think more than likely what's going to happen is that people struggle to find a home to buy. And let's say, remember the key drivers to buy a house are oftentimes, marriage and kids. And so in those cases, it's really about being in a single family home. So, we've not talked about this, but I mean, the single family rental market is also on fire right now. And I think, a lot of the demographic tailwinds in favor of that too. And so I think a bigger impact is on the single family rental market, or people who can't buy right now. They're probably still going to leave an apartment if they can and go get a single family home just to rent in. So, it's kind of a rising tide boosting all ships right now.
How about mortgage rates? That's another very, very hot topic right now. We're
Yeah.
recording this, by the way, in kind of later mid-April, just FYI for the listeners. And mortgage rates are much higher than they were a couple of months ago. Do you see that? I mean, I think the conventional wisdom is that that's pushed some folks or kept some folks in rental. Do you see a mortgage rate impact in that way?
Yeah, obviously I believe in price elasticity and laws of supply and demand. So certainly, as things get more expensive, it does narrow the pool a little bit, but it's not narrowing the pool enough to actually, so far, meaningfully impact the for sale housing market. There's just so much pent up demand right now, and not enough supply. And I think the other thing too, as well, it's definitely. I mean, people take a very, and I think you'd appreciate this. I mean, I think broader, like the media narrative, it takes a very short-term view of interest rates and mortgage rates. And obviously, if you go back to, even the biggest home selling period of our lifetimes and leading up to the great financial crisis in the mid 2000s, mortgage rates were more expensive then than they are now. And it certainly wasn't a blocker to people buying houses. And so at some point, we're obviously going to get there. It's going to be a driver, but I don't think we're really there yet at any kind of meaningful scale.
Yeah, I honestly, I agree. I think the mortgage rates certainly has an immediate impact, but the housing markets tend to sort of acclimate to the new mortgage rate reality and, use different tools or use different mortgage instruments or what have you, or just, acclimate to the fact that they can't afford the same price house that they could a couple of months ago.
Yeah, and one of the things I was more on too is at some point it becomes kind of a boy who cries wolf argument, because we've been hearing for years and years and years and years now. I mean, going back really to the earliest part of the recovery, that the home prices were getting unaffordable. The recovery was happening too fast on the home price appreciation side in certain markets, not everywhere. And certainly the last few years, we've been hearing about affordability a long time. Hey, it's going to slow. It's going to slow. And it hasn't really slowed down. I mean, inventory levels, as you know, are at ridiculously low levels. And so we're always going to hear that kind of noise in the background. But again, and it's going to, obviously, I don't want to be ignorant to the fact that at some point it's a factor. But again, we're just not there yet.
I agree. I think I am in the camp that it has to have an impact here eventually. It's already, honestly, I think it's already lasted longer than anyone thought it would, and
Sure, yeah.
fairly so. But it has to have an impact eventually here. We'll see when that happens, though. Let's talk about supply now. So that is, kind of one of those fundamental factors is that there is such low supply, a structurally low supply. What are multifamily residential actual permits right now? Is that just kind of scuttling along at 700,000 or so annually, or where do you see activity going, or how's it would you characterize it's been lately?
Yeah, no, there's a lot of new apartments being built. I mean, one thing that's different between apartments and single family is that, even prior to the pandemic, we had, 30-year highs in construction. While, on the single family side, obviously, we were nowhere near the highs we saw in the mid 2000s. And so apartment construction, we've seen a lot of interest in this among investors and developers, really through this entire cycle. The last 12 years now, there's been a lot of elevated construction. And really, that's just kind of tied to the demographic factors of, we just talked about earlier with millennials and now Gen Z. And so I think what the pandemic has done is certainly accelerated interest in it as vacancy rates have gone down. And we've kind of disproven this, supply as the boogeyman story over these last few years. I think it's given people more comfort level in building apartments. But the other part of it too, quite frankly, is that investors are trying to place capital into the sector, and it's very competitive to buy a stabilized apartment right now. And a lot of times they're finding better yields on a new development. So given low vacancy and rent growth, they're willing to take on the development risk associated with funding new development. And so, and of course, even taking a level beyond that, investors who are previously focused on office and retail are trying to reallocate into apartments and build for rent. And so, all of that is, you have the, kind of pure supply demand fundamentals, all the things we just talked about, plus this investor appetite for apartments and build to rents. And so that's kind of created this kind of perfect storm for, even more apartment construction than we had last year. So we're building more than 700,000 units across the country, which is the
Yeah.
highest level in 40 years.
Do you see any chance at all, any whisper of a possibility that there'll be adequate or even, God forbid, oversupply in the multifamily world in the near term?
Well, yeah, I mean, oversupply in apartments. I mean, these are the same types of voices of those who worry about affordability of for sale homes every year, and so, they'll be all be right eventually, but so far they've been wrong. On oversupply, it's like, there's been plenty of estimates showing that, on a macro basis, we're undersupplied by millions, and people can disagree about the number. The real question, though, is about the kind of the allocation of what's unsupplied and over to where there's oversupply. Meaning, like, most of today's construction is at a higher price point. Class A plus properties, high income renters, and we don't really have a great handle on the depth of demand at that price point. We've not run into a ceiling yet, obviously, but there's a little bit of risk there. But the other thing I would say on the flip side is, if you compare to 40 years ago, we're also much more diversified in locations of construction. We have, a lot of the construction today is going in places that we're seeing very little construction 40 years ago and just are undersupplied markets. And that's a lot of the Sun Belt, for instance.
Yeah.
And so, those two, that's where the demand's going. That's where people are going. And so the oversupply, the way I like to see it, and I think history tells us this lesson pretty clearly, is that oversupply is usually a short-term phenomenon associated with demand going away. And so people, if you look back at 2009, for instance, you can say, well, okay, we were oversupplied. Well, if you were a developer who had to exit in 2009, then yeah, you could say we were oversupplied and you paid the price for that. But if you had some flexibility and you were a longer term holder, you had maybe a prolonged lease up period, but you ended up just fine. That the demand returned really, really fast. And so at some point, demand goes away. I don't have a crystal. I'm not smart enough to know exactly the month and the day that happens. It'll happen eventually. Vacancy will go up. Lease ups take longer to lease up, but starts will then slow down, and then vacancy will go back down, and then it will be undersupplied again. And so all of these things are cyclical.
Yeah, it's like the city of San Francisco, right? When COVID hit, suddenly they were massively oversupplied because they had several apartment buildings going up in under cranes. But at the time, they were trying to satisfy a seemingly insatiable level of demand, and it made a lot of sense.
Yeah, no, it's true. I mean, it's all. I mean, it's cyclical. In San Francisco and New York City, I mean, those are two places that saw a lot more, volatility than the rest of the country. But yeah, you're right.
You mentioned a minute ago about how you're talking about Class A and how much incomes have gone up. It seems like virtually all of this new apartment building that's not subsidized in some way by the government and is literally below market rate is pitched at the highest level, the highest rental levels within that market. Is that an issue? Is anyone out there satisfying that, I don't know, B plus kind of space where it's not the highest rents, but you have new product for folks at a little bit lesser level of affluence?
Yeah, no, it's tough. A lot of the reasons that, land costs are going up, cost of labor, construction, materials, appliances. I mean, all of these costs are driving up the cost of rent. And so it creates a real challenge because, quite frankly, from an investment standpoint, the Class B story is even better than Class A in the sense that, like, you truly are undersupplied. It's very difficult to add supply. And in fact, you oftentimes lose Class B supply as value add investors upgrade these properties into a Class A. And so at the same time, this is the deepest demand pool, is the Class B renter. And so from an investment standpoint, it makes a ton of sense. So we are seeing a handful of investors trying to build into this space. Trammell Crow is one. they've started one where they're, as part of kind of an ESG initiative with some institutional investors on the social impact side, they're trying to
Okay.
build for middle income renters, and they've got a fascinating model for how to do that. And I think, everybody in housing should be kind of cheering on the success of that. I hope
Yeah.
it is successful and is a model for others, because we certainly need this to work. Um, but so far we just, it's not something we see a lot of for those reasons. It's just a very challenging, um, I mean, it's just, again, rising costs. You have to pass those costs on somewhere to get things done, and that means a higher rent. So it's a tough nut to crack, but certainly, hopeful that we see some success here.
Yeah. I just made a note to myself to get those guys on the show. That's
Yeah.
interesting. It sounds like a fascinating topic. Let's talk about the work schedule. We touched on it a little bit earlier with hybrid schedules and folks returning to the office at least to some level here very soon or already. Do you see this having a locational impact that's a differential kind of impact? The classic or the obvious idea is the cities gain, the suburbs maybe lose. Do you see that playing out?
Yeah, no, I think that the city and suburban thing has been, I think, one of the most fascinating things to watch through the COVID period. I mean, I think, as everybody knows this point, I mean, COVID really impacted the downtown areas the most. I mean, obviously, COVID, when you have lockdowns, it wasn't just the office factor. It was like all of a sudden I can't go out to the bar and to the restaurant. I can't do all the city stuff I'm used to doing. And so that had a real impact on the rental market there. And so when we saw this, I mean, first of all, I mean, the suburbs were strong even prior to COVID. I mean, we did a lot of research. In fact, reason I got plugged in with John Burns years ago, I gave a presentation at NMHC, I don't know, probably 6-7 years ago, on the strength of the suburbs and how it was an undervalued investment play. And so we've been bullish on that for a while. But what ended up happening is that a lot of these naysayers, like, hey, the suburbs are going to go back down as the cities
Mhm.
repopulate. And that never happened. We ended up seeing over the last 9 months that demand has returned to the cities. And what's really cool is it was not tied, and this is the part that really surprised me the most, it wasn't tied to the return to work aspect. It was actually tied to the return to city life. So in many cases,
Yeah.
people are going back to the cities, working from home, at least, maybe not 5 days a week, maybe they're working from home 5 days a week, maybe it's 3 days a week. But the reason they're back in the city is they want that city lifestyle, and they can have it again because the cities have reopened. But then the greatest part about this is that the return of the cities has not come at the expense of the suburbs or these, beach towns or anything else. I mean, we've seen demand explode. And I think part of that is that when you think about demand for a downtown apartment in a major city, there is an inbound train of young, highly paid young professionals, recent college grads, every single year. They're moving into these big cities. They want to be there. Young singles, higher income. Well, when COVID hit, that train stopped coming, right? People couldn't. And so now that train is going up again with new household formation pouring into those markets. But again, it's not so much of a boomerang effect of people going back into those cities, because those people didn't really leave in the first place, right? But it was more the people who were going to move anyway. So it's really been a fascinating dynamic, and certainly one that's been an encouraging factor to see there's really been no net losers in this equation.
So is it really kind of a situation where I guess both boats are floating because you have
Yeah.
limited supply and demand enough to fill up that limited supply in both urban and suburban settings? Does that
Yeah,
make sense?
absolutely. It's a rising tide boosts all ships, and again,
Yeah.
there's a lack of housing in all price points, all housing types, and all markets, and so that rising tide is suburban apartments, it's urban apartments, it's single family rentals, it's build to rent, and it's for sale homes. It's everything.
How about some threats on the horizon other than anything sort of fundamental? Do you see apartments, if threatened is the right word, do you see apartment sector being threatened by the burgeoning build for rent space?
Well, okay. So first of all, I do believe in there's real threats, and a good chunk of my time these days is talking to rental housing investors about some of those threats. But I'll come back to that. In terms of build to rent, I don't see that as a threat. I see it as more complementary. For the most part, a build to rent community is catering to a different demographic. They're people who are a little bit older. They're more likely married, more likely to have kids, more likely to have pets. They need a little bit of a yard. And also they tend to be located in places, for the most, I don't want to overgeneralize here, but for the most part, they tend to be located in different locations. But really, it's the lifestyle factor. It's a different demographic, and it's still in its infancy. And so I think a lot of apartment investors and managers, I mean, they see build to rent as a natural extension of their apartment portfolios. It's just a way to retain their customers for a longer period of time. But a build to rent community, I mean, a lot of these are basically apartment communities, but with detached walls and a little bit of a yard. Like that's really the main difference. But there's a leasing office, there's a community pool, there's all this other stuff, just like an
There's
apartment community.
maintenance, there's services. Yeah.
Yeah, on-site service. Yeah.
Yeah, that we find that's a huge factor. How plugged in are you in the Phoenix market? Because I'm going to ask, that's the one market where BFR world, the build for rent, has really just exploded. And there's a ton of activity there, more on the way. Has it impacted the apartment market even in Phoenix?
Oh no, I mean I agree. I mean, Phoenix obviously seen a ton of this stuff, but the Phoenix apartment market is one of the hottest in the country. I mean, we've seen 20+% rent growth consistently, low vacancy, lots of new apartment construction. So it's definitely not been a negative factor.
BFR is not really a major threat. Do you see other potential threats to the apartment sector?
Yeah, no, I mean, build to rent. And one last thing on that is, I think it's a great strategy because it really meets a group of people. It meets a need that just isn't well served today. People who want all the conveniences of living in an apartment community, but also want more space in their own yard and detached walls. So again, big fan of that. Now, in terms of risks, I mean, a lot of them, there's kind of two main categories. One is policy risk. We're seeing a lot of focus right now in cities across the country on rent control, which is amazing to me because it's one of those things where you survey economists from the left, the right, socialist, to far right, far left. Everybody opposes rent control. There's no academic research of any substance that shows that rent control actually achieved its main objective, which is to make housing more affordable. And yet, for a broader population, obviously protects a small share who are in place when rent control is enacted. And yet we continue to see cities kind of fall over each other to make the same mistakes, which ultimately end up constricting housing supply and making affordability even worse, which is why cities with rent control tend to be some of the most expensive places to rent for a new renter. So that's a major threat to affordability across the country and in turn to investors and operators. But also we're seeing things like screening limitations. You're seeing cities and states that want to limit how we should regulate how we review who should live in a community, like criminal background checks, things like this. And, there's some risk there. You want to have a safe community and you want to make sure you're doing that right. And then the other thing I'd put in there, the other category is really two more. One real quickly is fraud. We're seeing a big rise in renter fraud. People buying fake IDs and kind of renting under a false pseudonym and then not paying rent. And that's been a challenge. And then you also have just kind of general market force challenges. You have supply chain issues, you have inflation, you have staffing shortages. I mean, all of these things are certainly, big headwinds also.
Yeah, inflation too. That's worth mentioning, I think, because that cuts into your available income for your residents, and that combined with rising rental rates, that could be. You could see that being a potential threat down the road.
Well, and particularly if we get to a point where rent growth slows down because wage growth slows down, but your inflationary costs as a housing provider still go up, that's when it's a real concern. So I would definitely put that in the risk category.
Okay. Let's do a quick hit on amenities. Do you track amenities? Do you see any, kind of the hottest amenities coming or some new amenities that are becoming more and more popular in new apartment complexes?
Yeah, absolutely. I mean, first of all, I have to relay a joke I heard from one of your colleagues on stage said, the best amenity right now is an available unit. And I think that's definitely true. But, that aside, you look at new development, there's a lot of talk about, kind of work from home space. And it's not so much a dedicated office, so much it's about, having flexible use space. And so, an area where you look out the window and you're just a little more flexibility where it's not an office, but it's a more adaptable work from home environment. And then the other thing we're really because again, this is a structural change, because you don't want to bank too much on just people working from home. You just want to have that flexibility. But the other thing I think is interesting is, there's these, everybody talks about the so-called amenity wars that people, trying to build fancier kitchens and bathrooms and all the and flooring and on the list. But, the other thing we're really seeing is more focus on outdoor community amenities. And so it's not just about the pool anymore, but it's about having inviting outdoor space, where, you have if you have the right tract of land for it, maybe a walking trail, maybe an outdoor space on, a grassy area to, play catch, or to, do some outdoor exercise, or just hang outside and read a book and do some work, and maybe some desk space outside or some seating areas. So all of that, beyond just the old pool, is a big focal point right now, being outdoors. And I think that's one where COVID, everybody wants to they don't want to respond to COVID, but they want to look for shifts that maybe COVID accelerated. And I think that's a great example of one. It's
Okay.
like, it's one of those things you're like, well, yeah, like pandemic or not, like I want to be outside more. And if I had a better outdoor space, I would use it more. So I think that's one that's really here to stay.
During the height of the pandemic, a lot of folks were talking about these indoor outdoor spaces, these flex spaces. Has the apartment world kind of gone away to that and gone full on outdoor? Or are you still seeing that indoor outdoor kind of, I hate to jinx the world, but kind of for that next event like that may be in the not too distant future?
Yeah, no, we're seeing events. In fact, we did a webinar recently with one of our clients on this, and yeah, the events are back for sure, and so people want to mingle with each other again. So yeah, those indoor outdoor flex spaces are great. I think the key word you just said there is that flexible use space. In prior years, we saw big things about like, we're going to build like demonstration kitchens and bring in guest chefs who are going to do really cool stuff. We're going to build dedicated community office spaces and those kind of things. And like, movie theaters is a big one. Those things that are very specific use spaces, those I hear less and less about. It's more about what you just said. It's that flexible use space that's more important right now.
That's interesting. Okay. Our last topic will be about money. Why not? The investors and investor interest in apartments. Is investor interest in apartments, you mentioned earlier, it's huge right now. Is that because they see it as kind of a safe zone relative to other sectors?
Absolutely. I saw an interview with CalPERS recently, saying that, they're with inflation, they're focused more on real assets. And also they mentioned private equity. But, I think that people, the old adage is that real estate's a good hedge against inflation. When you look at real estate, you see a more nervousness now about retail and office. And so that really leads you to rental housing. And so, of course, a big part of that is apartments. And as well as industrial, I should say. And so there's a lot of capital that is attracted to apartments. And for those reasons, you want to be involved in the real estate, and you see rental housing as an attractive vehicle with kind of long-term staying power, as well as the ability to kind of pass through inflationary costs in the form of rent. And so all of those things are kind of viewed as positives among investors. And the other thing I'd point out too is it's a lot of it's a structural shift as well. I mean, if you go back to, 10 plus years and pre-GFC, apartments were viewed as kind of a higher risk profile relative to office, and certainly less core. And we've seen a big shift in that over the last decade, where now apartments comprise the majority of commercial real estate sales. And again, I think COVID really just accelerated that trend further. It wasn't so much it changed it, it just accelerated it.
Do you see a BFR, which has had this groundswell of investor interest in the last couple of years and beyond? Do you see that competing with the apartment world for capital, or is there enough for everyone?
Well, quite frankly, there's more capital than there are opportunities right now, and so it's really the investors competing with each other to get into either one. Now, that won't always be the case, of course. I think over time, as the markets normalize, we're going to see more competition between the sectors for that capital in certain areas, and it becomes more kind of site specific. But right now, we see a lot of dry powder out there, a lot of investors who want to be in, frankly, either one, and are having a hard time just placing that capital into getting the deal. So no, they're really not competitive. It's the competition is between the investors, really.
Yeah. You mentioned that we talked earlier, and you mentioned sort of the relative size of the two sectors. So
Yeah.
what is the measure if measured by capital, apartments versus BFR, what kind of size difference are we talking about?
Yeah, I think y'all put out some really fascinating data showing something like $55 billion in capitals is being placed into build to rent single family right now. And to no fault of your own, because it was a great data point, it got miscast in the media as like this, oh my goodness, like build to rent is absolutely on fire. This is crazy money going into the sector. And of course, for any of us regular people, 55 billion is a ton of money, unless we're Elon Musk, right? But you know, but in comparison, it's still tiny relative to apartments. I mean, we're selling 250, 300 billion in apartments in a given year. And that's just on the acquisition side. And I say in a given year, in recent year, in the last year, and probably for this year. And that doesn't even account for the new development. I mean, we're building 700,000, units right now, which if you extrapolate that out, I mean, that's, I don't know how many tens of hundreds of billions of dollars that is. I should in the math. I
Yeah.
mean, there's a lot more money in
Yeah.
apartments right now as a function of that sector being a lot more mature and more developed.
Yeah, I think that does. I think you're right. I think that does get lost. Yes, BFR is exploding, but it still isn't to near the size of the apartment world.
Yeah, it's again to go back to like that low denominator factor. It's like
Yeah.
it's exploding from near zero. I mean,
Yeah.
I keep giving y'all credit because y'all put in such good stuff, but y'all have a really good pie chart that shows the existing. I think it's a total of like there's something like 200,000 build to rent units across the country, and which is nothing. And something like half of it was built in the last like 5 or 10 years, something like that. I mean, it's crazy. I mean, it's still a tiny market with a ton of opportunity. I'm again, not to be redundant, but I think there's just a ton of upside. We're nowhere near being overexposed to build to rent.
Jay, I think I know the answer to this, but where are you based right now?
I'm in
Look,
Dallas.
Dallas. Okay, because I started hearing about 4 or 5 y'alls there in quick succession. I
Yeah,
like it. I like started
yeah,
to
yeah.
started
Well,
to sneak out there.
I'm a Carolina native, so
Okay.
I
Okay.
inherited that. Yeah.
So I'm going to end with two questions that are going to annoy you, and this is intentional.
Oh, good.
I am going to ask you first to look into your crystal ball. How long does this last? How long does this very strong apartment market and a lot of interest from investors last?
Yeah, no, that is a tough question. We all like to say it depends, right? So, I honestly, I mean, I'll give you my best guess, but I don't know. And I'm very skeptical of people who claim they do know. And so I want to be on record saying that I don't really know. So,
Yeah.
but no, I think that there's still, I still think there's a lot of runway left here. My view is that we're going to have some hiccups along the way where you're going to see some, kind of stops and starts and some slowdowns and some valleys. But overall, we're going to continue to march on a kind of upward trajectory. And a big reason is just the demographic factors. I think that the demographic factors are very positive for the next, 10 to 20 years on just, baseline demographic growth for young adults and maybe beyond that. So again, it's not, I'm not saying that we're going to see, continued boom times for the next 10, 20 years, but I think I think the challenges are going to be more short term, economic challenges. We kind of stumbles along the way. I don't foresee any kind of massive factors for a long term slowdown.
Yeah, I think that's fair. So, I mean, yeah, when and if the recession hits, because we always have them, those economic cycles are called that for a reason. Yeah, obviously demand is going to be decreased, but that fundamental underlying demographic demand fueling is going to be with us for a while.
Yeah, absolutely. Yeah, it's demand's going to come up and down, but the long run is going to be a positive story.
Now, my last question is the one that has annoyed me many times when I've been on the reverse side of this. Some media folks will say something. I swear to God, sometimes they've ended an interview by saying, "What haven't we talked about that I should know?" So I'm going to ask you that in the apartment world, what haven't we talked about that we should know?
Yeah, I took some journalism classes in college, and I remember this as something that was always taught. Um, I think the one thing I would point out is that we get asked a lot about rent versus buy and how one sector is impacting the others. There's a Wall Street Journal article that came out. I mean, here we are in again mid to late April. There's an article just came out about there's HOAs across the country trying to ban rental providers from acquiring homes. And so I think, one other thing I would just kind of generally throw out there is I think that there's too much worry and focus about renting or buying, homeowners or renters, and what's causing one or the other. The real, I think, just kind of punchline to all this stuff is that we need more housing. And if you look historically, rentals and for sale homes, with the exception of 2010, early stages of the GFC recovery, they've generally moved in alignment with each other. They're complementary. They both rise and fall with the same demographic and economic tailwinds. They don't compete for the same people for the most part. They serve different life stages. They each play an important role. And so I think that's important. And it also, too, I think, you look at kind of broader rental policy. I think that, all of these, any kind of movement that these talks about, hey, we should look at rent controls, we should stop investors from buying homes and renting them out. Like all of these things, I think, are very, negative headwinds against long-term affordability. I mean, the fact is that we just need more housing. And I think a lot of times we're kind of bark up the wrong tree when we get mad at investors who provide housing, as opposed to getting mad at our policymakers who've made it ridiculously difficult to build new housing, and particularly at more affordable price points, and they're underfunding affordable housing. So that's kind of the big thing that I've been trying to harp on lately, is just that, hey, the biggest challenge we have is undersupply of all types of housing. And we need cities across the country to tear down the red tape and the NIMBYism and the zoning restrictions that limit new housing construction. And ultimately, build. That's the best antidote to affordability and accessibility challenges we're seeing today.
Okay. And the reason folks ask that question is what I would not talk about is because they want their next article or next story. You've already given me a future podcast, the Trauma Crow thing. So you've done double duty here today. Jay, appreciate you coming on. It's been great.
My pleasure. Thanks for having me.
Awesome. All right. This has been the New Home Insights podcast with your host, Dean Worley. We'll see you in a couple of weeks.